Hello, everyone. Thank you very much for joining us today. I've got our guest speaker with us, Matt Butcher from My Broker Solutions, and myself, Kaylee, is the Director of NB Property Law. We're going to be speaking about the home loan wake-up call today, so going through the hidden risks that can derail your property deal. So a little bit about myself. As I mentioned, I'm the Director at NB Property Law. So we showcase, a range of different matters, but I deal predominantly with commercial property and estate planning law and work closely with individuals, families and business owners to help them navigate complex property transactions, commercial contracts and long-term asset protection strategies with confidence. So we've got extensive experience in estate planning and also commercial law, and I advise my clients on wills, testamentary trusts, asset structuring and succession planning, and making sure that their wealth and business interests are protected both now but also into the future. So I've got combined commercial and property background, so it enables me to be able to deliver integrated strategic advice to support our clients' business growth, their risk management, and also their long-term wealth preservation. So I'm passionate about commercial estate planning and property law, and I'm always striving to provide my clients with holistic, practical legal advice aligned with my clients' broader financial and business objectives. But above all, I always make sure that I'm prioritising to deliver my advice in clear commercial terms to ensure smooth transactions and the outcomes that genuinely support my client's success. I'll pass over to Matt now to introduce himself.
Yeah, hi, I'm Matt Butcher from My Broker Solutions. I'm the owner of My Broker Solutions. We're business brokers, but we also work in the business finance and home loan space. We jumped into that market just because there was a lot of business sales that weren't going together. Then COVID hit and we became quite prominent in the home loan space, working as brokers. And we want to help you through that intricate space where you're trying to look at different solutions. We're not all fitting into a box anymore, and we're going to help you through, and we're going to talk about the pitfalls around home lending. Thanks, Kaylee.
Wonderful. Thank you very much for that, Matt. So what we're going to go through today is understanding when your deposit is actually at risk when you've entered into a property contract, navigating the actual legal risk from getting finance approval until the settlement date. Matt's going to talk about the truth about banks and the lending and the buyer's loyalty. We'll go through improving your financial position before actually applying for a loan and how to avoid the common buyer pitfalls in today's property market. So first up, we're going to speak about what actually is a deposit then and when is it actually payable. So the deposit is essentially the security to the seller that the buyer will comply with their obligations under the contract. So once you sign a contract, you'll be obligated to pay generally a deposit. It's often broken up into two payments. So an initial deposit, which is payable up front, generally within 2 business days of signing a contract. And then often there's a balance deposit, which is payable generally upon going unconditional, might be again 2 business days after the unconditional date. Now, that deposit is generally kept in a trust account, either of the agent if there is one and they've got a trust account, otherwise generally the seller's solicitor. No one will have access to that deposit until both parties to the contract authorize it, and generally that will be upon settlement. If the contract is terminated, then it will go back to terminated due to one of the conditions failing. It'll go back to the buyer. Otherwise, if there's default, depending on the default, if it's the buyer's default, the seller may be entitled to actually keep that deposit. Now, a deposit generally can't be more than 10% of the purchase price for a standard existing property purchase in Queensland. However, if it is an off-the-plan purchase, it can be as much as 20% of the purchase price. So as mentioned, it can be broken up into 2 ways. Now, you can have a deposit that's paid, generally it's paid by cash. It could be paid by a bank guarantee. It's not normally paid by a bank guarantee in a normal existing property purchase, like of an existing house, because it's quite a short settlement, but sometimes we often do see the bank guarantee being used for those off-the-plan contracts where it could sit in a trust account, for a couple of years. So when does your deposit then become at risk of being lost, essentially? So if you are the buyer and you breach an essential term of the contract, you could be at risk of losing that deposit. Essentially then, you need to understand what is an essential term in the standard REOQ contract, and there's several of them. One of the critical ones is time is of the essence. So with every time and date that's stipulated in the contract, it is very strictly, it must be adhered to, otherwise you could be in breach. You could be at risk of the losing deposit if it's not paid by the due date as well. Paying the balance deposit, paying the balance of the purchase price, I say, on settlement. So, if you fail to do that, so you don't settle on time, essentially, again, you could be at risk as the buyer of losing that deposit. And any other term that the court essentially finds to be an essential term of the contract as well could put you at risk of actually losing that deposit entirely. So when are you then entitled to get the deposit back as the buyer? So if the contract is subject to any conditions, the most common ones are building and pest and finance, and you don't get, and you're not satisfied with either of those conditions, then the contract can be terminated and you can get the deposit back. Some of the other conditions you could make the contract subject to maybe things like due diligence. If it is part of a body corporate, you could make it subject to a body corporate comprehensive record search. And again, if you're not happy with the outcome of those searches, that deposit would be refunded then to the buyer. If the seller breaches an essential term, the buyer is also entitled to terminate the contract and get that deposit back. Again, one of them may be the actual seller not being ready and prepared and turning up to settlement, and that would mean the buyer is then entitled to seek that back. So how do contract clauses and timing missteps, essentially derail an actual purchase? So as I mentioned before, time is of the essence, but what does that mean? So it basically means that there must be strict adherence to the deadlines. So a failure to meet any of the deadlines could result in having to give the other party the right to terminate the contract and put that deposit at risk if you, as the buyer, are the other party breaching that condition. So we had a client come to our office, recently seeking our advice after their purchase was actually terminated by the seller and their conveyancer was actually unable to assist them for whatever reason. So how did this come about? So the buyer in this situation, they wanted the right to inspect the property they were purchasing before settlement. So they included a special condition that gave them the right to do an inspection, essentially for due diligence. It was great in theory for them, they thought, but in practice, they had organised with the agent to do the inspection after the due date of that due diligence condition. And as the seller, they weren't available to provide that access before that date either. So what happened is the buyer assumed that because the seller knew that they weren't able to do the inspection until the day after the due date of the due diligence condition, that it would be fined. And then the seller didn't respond to their conveyancer's request, actually extending to request the extension of that due diligence condition. So in fact, it wasn't fine. And because time is of the essence, the seller had the right to terminate that contract. And the seller in this case did in fact terminate the contract. The buyer received their deposit back, but they didn't get the house, which was the bigger problem for them. We were thankfully able to assist this buyer and we did get their house settled, but that was only because the seller was the reason basically the buyer wasn't able to do the inspection in the first place. So it is really important, unfortunately, that condition that had been drafted regarding the due diligence, hadn't probably been drafted very tightly to make sure that they were allowed to do that inspection. And also from the buyer's point of view, they... Sorry, Mao, can you put yourself on mute? Sorry about that. Yeah, so the condition, the due diligence condition hadn't been drafted very tightly, which was an issue, but also the fact that the buyer was a bit naive in thinking that just because they hadn't formally got the extension for the due diligence condition that it would be okay. Now, the other timing missteps in practice. So you need to be aware that when you sign the contract, and if it is subject to finance approval within 14 days, you have done the right thing and you've got your pre-approval in place and started the application as soon as the contract was signed and provided everything promptly. You need to make sure that you're acting straight away to make sure you can try and meet these deadlines. The due date comes around and you're still waiting on that formal finance approval letter to be issued though. And you might have been assured that it's going to come through any time, but it's 4 p.m. Essentially, all these conditions are due at 5 p.m. In this situation, the agent, they're verbally advised that the seller doesn't mind if you take an extra day or two. Note, this is not a formal agreement though. So as a buyer in this situation, you need to go with one of these options. You can request an extension of the due date for finance. You can waive the condition if you're confident and aware of the risk and happy to take that on, that finance is approved even without receiving that formal finance approval letter. You can obviously terminate the contract as you hasn't actually got that formal finance approval letter by the due date, or do nothing at all. So there's a few options, and there's risks with each one of them. So the seller could grant the extension if you request it, and in that case, the contract would remain subject to finance approval. However, the seller doesn't have to grant the extension, and then you'd have to make the informed decision, do you satisfy and just waive it regardless, or are you going to terminate? So this means the condition, is no longer, if you are to waive it, the contract's no longer subject to finance, and you won't have the right to terminate, and you're going to be required to settle. So if for whatever reason you don't get that formal finance approval letter, you will be in breach of the contract if you can't actually settle, which would mean that you could have to forgo your deposit, and you are subject to further damages as well by the seller should they pursue it. Now, those further damages, essentially, if it ended up going through court, is to put the seller in the same position they would have been in had you settled the contract. So, for example, if the seller ends up selling the property for a lesser purchase price than what you were paying, taking into account obviously the deposit they've already got from you, you could be responsible for the difference in that. If you just decided that, you haven't got your approval letter by 5 p.m, you're just going to kind of contract, obviously the contract's then just at an end and terminated validly, and the deposit would be refunded back to you as the buyer. The last option is, if you did go ahead with this one and just waited and did nothing, wait and see what happens. If you get finance approved, the seller could terminate in the meantime, they could do that. And, if the seller does terminate, you would still get the deposit back as well. But obviously you're not going to be entitled to buy the house still. Now, who's responsible for each stage of the process, and what happens, when buyers lose control? So when looking to buy a property, obviously that falls on the buyer, and if they've got a buyer's agent, that buyer's agent. When it comes to preparing the actual contract and the seller's disclosure statement, that's generally done by the seller, their agent, or their solicitor. Doing the investigations and satisfying the actual conditions. So like I spoke about, your finance, your building and pest, if you've got due diligence or things like that. Again, that comes down to the buyer. Their agent will be working with them on that if they've got one appointed. Also their mortgage broker like Matt, and us as a solicitor, and those third parties like your building and pest inspector. Everyone needs to be working together at this stage to make sure those timeframes are met. If we do need to get extensions or anything like that, that they're put in ahead of time. Once we go on conditional though, the buyer will need to make sure that they actually sign and return the mortgage documents and provide all the requirements to the lender, as soon as possible, because sometimes there's a short period sometimes between that unconditional date and settlement date. The good thing now as well in Queensland with most of with all the REIQ contracts, they do have a standard extension clause allowed for settlement. So for whatever reason, you can't settle, this goes for both parties, the buyer or seller. Either party can automatically now extend settlement by up to 5 business days if needed. So for whatever reason, you weren't able to get, all the bank loan documents and things sent back and the bank verified them before due date, we could utilize that extension if needed. So within a week of settlement, the buyer and potentially their agent will need to complete the pre-settlement inspection. Now, the purpose of the pre-settlement inspection is to ensure the property is in the same condition it was when you signed the contract. So, and we need proof of that. So, if you come, to us and say, there's a big hole in the wall, we need to be able to say, well, we've got photos or videos, that wasn't there then, it is there now. However, if potentially like there's, there could have been a big rug over, a ripped up carpet underneath the carpet or something like that, that could have been there at the time you did the entered into the contract, but you just didn't see it. So you need to be mindful that it wouldn't be covered off on it. We need to be able to prove that the issue wasn't there at the time we signed the contract, as opposed to it being there and it just not being visible to us because, you know, we've not lifted up the rug or moved out a couch or something like that. From our point of view, what we're going to be doing to prepare for settlement is we'll complete the adjustments of outgoings. So that means, you know, we'll have your purchase price less your deposit you've paid, and then adjustments will be for the outgoings include things such as rates and water, so that they're adjusted on a pro rata basis, being the period of time that the seller owns the property and the period of time that you will own the property as the new owner. And make sure that those things are all paid out as well come settlement date. So we'll also be preparing the necessary documents for the seller to sign to actually legally and formally transfer the property from the seller into the buyer's name. And we'll also be making sure that all the relevant parties are booked in to attend settlement. So we'll have your bank, if you've got a bank, engaged in the work. We settle on an electronic workspace known as PEXA. So we'll have them in the workspace, obviously the seller's solicitor, and the outgoing bank as well for the seller if they've got one. The bank will also make sure that all the documents provided by you are correct. So like I said, they'll be doing their verification process to make sure you've signed everything correctly and everything is in order for settlement day. So on the actual settlement date then, as a solicitor, we are ensuring that all the paperwork is actually complete to allow the property to actually be transferred. So we electronically will sign off on those transfer documents on the buyer's behalf. We'll also request that the total funds required from the bank, so whatever loan amount that the bank is providing, we'll request them, so they're putting into the workspace. Often the banks may have a shortfall authority, so they might be lending, for example, 500,000, but we need 600,000, and therefore you as the buyer will have to come up with that $100,000 difference, but they'll have an authority to withdraw that from your nominated account. Otherwise, if they don't, we'll let you know ahead of settlement and that'll come into our trust account so we can upload it to the settlement workspace. The bank will finalise off the lodgement of the documents. So they're the ones that are going to be basically attending to making sure that the seller's release of mortgage is removed from the title, the transfer documents are registered to put the property into your name, and then their mortgage documents are also put on title. You as the buyer will just need to make sure you've got those sufficient funds in either your nominated account or obviously in our trust account come the time of settlement. So how can it all go wrong then? So the main issues that arise is the bank not being in a position to actually hand over the money, or if you're a buyer, not being ready to hand over the release of mortgage if you're the seller. So, you know, like I said, this can happen. The good thing now is that we do have that bit of leeway with that 5 business day settlement extension. So we can automatically extend that by 5 business days if needed. However, the issue can come if those 5 business days are not sufficient enough and we're still not ready to settle and we need to extend beyond that. We need to actually then seek consent from the other side to agree to that extension. So if they don't agree, so then they're not willing to agree to any further extension, you know, we are at risk then of failing not to settle, and we will be obviously in breach of an essential term of the contract, and we could, as the buyer, potentially lose our deposit. If they do agree, though, to extend the settlement date beyond, you know, the 5 days that we've automatically sought, they can also impose penalty interest as well. The contract allows for penalty interest to be charged for each day that settlement is delayed, and that amount, you know, could be charged. Sometimes sellers will charge it, sometimes they don't worry about it. They might give it. Sometimes they, you know, allow you not to pay penalty interest on the first extension. If a further extension is sought, then they could impose a further charge. And sometimes they'll also charge, you know, their solicitor will also be charging increased fees, which they could on charge as well to you as the buyer. So how do you then protect yourself from, you know, once you've signed the contract, you know, until the actual settlement date? So the number one thing for you to do is make sure you keep clear and open communication with us as your solicitor, and also, you know, Matt as your broker, who's going to be in conjunction with your bank, and also the sales agent in the matter. You want to diarise the important due dates, so making sure that we're adhering to them. Once we always get a contract, we'll work out and review that contract, work out what those key dates are, send an initial letter of advice to you outlining them, and then, you know, come the date that those due, we'll be touching base with you to see where they're at. We don't want to leave anything to the last minute when asking for an extension, because it just may not allow the seller sufficient time. You know, we're not going direct to the seller, we're going to their solicitor, who's then got to go to the seller. You know, they could be caught up in things that they're not going to get back to us if we ask them, you know, even within an hour of the due date. So, and, you know, that's a risk for us, you know, exceeding that time frame as well, that they don't have to agree and could just terminate the contract on us. So make sure that you're promptly completing all your required paperwork and tasks as the matter proceeds through. Don't just rely either on verbal confirmation that extension will be granted. You know, like I said, often an agent may say, oh, yep, it's fine. Like the buyers, you know, they've got no issue with you extending it. We need to make sure that you actually get your solicitor to get that formally confirmed in writing, and so that it is then binding on you. If you need to increase your daily transfer limit as well when it comes to the deposit, or transferring funds, you know, to our trust account if needed for settlement date, then make sure that's done ahead of time as well. You know, you've got to get your bank's authority to increase whatever your daily limit is, and make sure you're actually paying that deposit by the due date. We don't want to be, again, at risk of breaching the contract because we're not adhering to that key date. And always good to make sure you keep a copy of that remittance advice for the deposit when it is transferred, and even money to our trust account, so that we've got a paper trail and confirm that it's been done correctly. That's about it for me. I'll hand over now to Matt to take you through the home loan process.
Thanks, Kaylee. Yeah, Matthew Butcher, My Broker Solutions. Look, we work in multiple spaces, but today's about the home loan wake-up call and what are the pitfalls around getting finance and what can go on. Now, I must stress that this is not a bank bash on the way through, so it can sound a little bit like that. But look, first question is, why would you use a broker instead of going directly to bank? So what traditionally happens in this space is I've banked with the same bank for the last 20 years. They know my history. They know all about me. They know what a great customer I am and how I pay everything on time. So I'm going to go into my bank and I'm going to get the best deal. Loyalty with a bank is not where it used to be. Look, my business model is that if I look after my existing customers very well, they'll stay with me and I'll make sure that they're a priority within the business. That's not necessarily the case with a bank. So the bank will offer you, they've got a record of your history, but they're not looking at it in the overall scheme. So they may change policies along the way and start looking at, you might change the way that you're getting paid, or you might go out by yourself and start working for yourself, and their policies might not work necessarily with your side of things. So so why would you use a broker? First of all, we're free. We're paid by the banks. All the banks pay fairly similar in the way that they reimburse us. We get paid an upfront commission and a trail. The trail is really so that we can keep you and look after you for a longer period of time, try and keep you associated with the same institution. We want to try and keep you with them, and we're not shopping you around all the time to different banks. Look, we work for you and not the bank. So our whole goal is to make sure that you're in the best situation possible. There's something that's come in through the Royal Commission that came out a few years ago where they investigated the banks and its best interest duty bid. This applies only to brokers. So if you walked into a bank and the bank's got a product that is, say, 7%, and they've got another product, 5.5%, this doesn't generally happen, but they don't have to offer you the 5.5% product. Us as business brokers, we have to put forward all of the best options that we have available to you. And if you choose not to take the cheapest interest rate, for instance, we have to document and prove why you've chosen that. Now, that could be because they have a quicker turnaround as far as how quickly they can get it done because you're buying a house and you need it done quickly. It could be to do with the policy around your employment that they might take a higher level. It could be an offset account or something like that you need as a feature of your product. So, but also we workshop the deal. So the whole idea is we'll shop it around. We'll look at all the different lenders that are out there and try and find the best deal for you and what's going to set you up longer term. We're not just trying to set up this loan for you. We're trying to set you up for the best way for your future. And if that's working around other strategies and things like that, we're going to talk to you about how we're going to do that for you. One of the things that's coming out of the AI age is that pre-approvals are not always assessed. A lot of the lenders now, a pre-approval goes to them. It is really just based on policy. So if you declare that I earn $100,000, I've got this amount of money in the bank, and this is my setup, these are my debts, these are my credit cards, it goes through an auto AI approval process. So nobody has actually assessed your documents. Now, one of the things that can happen within a bank or something like that is if you say you get commission, your PAYG, and you earn $100,000 a year, and $70,000 is your base wage and $30,000 is your commission. So you've just gone through, the bank's taken your $100,000 as gospel, and that's correct. And then when it goes to the assessor looks at it and says, well, wait a second, you've earned $30,000 commission this year, but last year you only earned 10. And our policy says that we're going to use the lower of the last 2 years commission. So all of a sudden your income is $80,000 instead of 100, and you don't service for the loan. So what we're trying to do is we're actually assessing all of this stuff and working with their policies before we go to submit. So just keep in mind that pre-approvals are not always binding and can be withdrawn. And they're not assessed against a property. So if you buy outside a postcode that might be seen as a regional postcode, that could come up as high risk as far as a lender's concerned, and they might not have an appetite for that region, or they might be overexposed in that region. What you don't realize is behind closed doors, the banks have risk matrix that they're getting assessed by. So they're looking at, are they overexposed to the first home buyers in the area? Are they overexposed to self-employed in the construction industry? Are they overexposed in mining towns? So they're looking at things like that in their background. So if you go to them and you're self-employed in the construction industry, working in a mining town, and you're a first home buyer, you might hit one of those matrix and they're going, oh, okay, this is a high risk application, even though that you've banked with them for the last 20 years and never had a default. So just keep that in mind, that we're trying to find these solutions for you in moving forward. Now, I'm being facetious here, but the quote on the side is, a bank is a place where they lend you an umbrella in fair weather and ask for it back when it rains. Look, it's probably a little bit harsh, is the honest truth, but the truth is that they'll want to lend you money when things are great and you've got enough servicing to do it. But when things get tough, look, you wouldn't be lending people your money in that space. And look, I comment about one of the lenders has got a TV commercial at the moment where they talk about the kid playing the drums, and we'll lend some money to buy a drum kit, and then we'll lend them some money to start a business, to open their own, start their own band. Look, unless the parents have got money behind them and an asset behind them, it's very hard to get money in that space, is the honest truth. So you've got to try and find the right people around you to try and help you with that side of it. Now, your deadlines as far as a finance clause, and Kaylee was talking before about we want to know as soon as possible if you're not going to make a deadline. It's very hard to get a file escalated through a bank or a lender in that space, because look, the truth is these people are sitting there and they've got 30 files on their desk that all have to be done today. They've got deadlines on every single one of it. They've got brokers and bank managers screaming at them to try and get these done in time, and they've got their own KPIs that they've got to achieve. So they're working to their own internal queues, not your contract dates. So it's our job to try and escalate that, and if not, we want to communicate as early as possible with Kaylee so that she's got time to go back. There's so many files that get picked up at 4 o'clock on that last day, and it's so frustrating for everybody involved, because the stress that's involved for you as a purchaser, and a lot of people, they do this once every 10 years or once in their lifetime, and the amount of stress that you've got where you're not sleeping because you don't know whether you've got the property. So a lot of times we're taking our deals to our second and third tier lenders, mainly because we're actually talking to a person. We're actually talking to a person that picks up the phone, and we can talk to them about your circumstances. We want to really personalize your experience as much as possible. We've even started on some applications putting pictures of you guys when you're applying for a loan, because the bank manager, the person that's sitting there assessing the credit, they don't actually see that it's a person. They see a list of numbers, and we want to keep coming back that there's a person involved in all of this that is losing sleep over decisions that are getting made. Sorry, I just clicked on. Another thing is when you go to auction, you have to keep in mind that your finance is not unconditional. So you buy at an auction, you are actually going unconditional on the property, but your finance is not unconditional. So it's still subject to evaluation. Now, not in this current climate, 95% of valuations are standing up at auction because the valuers see it as it's a competitive market. There's two people bidding against each other, and that is setting a realistic price for the property. But and it may come up again where in the future where if it's a different market that we're in, and people are paying ridiculous amounts over the reserve of the property, then the valuers might not stand up in that space. So what we need to do as brokers is we need to be ready just in case a valuation doesn't come in. Or a thing we're starting to see is a little bit where market volatility in valuations is starting to be seen as higher risk by the valuers, and some lenders aren't accepting that as a valuation because of it. And look, the last thing is when finance delays become legal problems. Generally, when we apply for a loan, we'll get asked extra questions. They might be about something in a bank statement where they see an unusual transaction. It could be about a pay slip that's, why is it reported that way? Might be, why is the income tax return from the previous year slightly different to everything or reported differently? They're normal questions that we get asked in the process. Sometimes if we get asked 3 or 4 or 5 times extra questions, then we start to see some flags that are coming in. And that's more to do with the fact that the lender just doesn't like the deal. The credit assessor just doesn't like what's going on. So they're looking at it and they're trying to find reasons to decline. So for us as brokers, we kind of have a bit of an inclination that they're asking more questions than they should be. So we're starting to do some research behind the scenes. We still would like that loan to go through with that lender because that's the first choice. But we're starting to look at ways that we can look at other lenders, maybe a Macquarie or somebody like that that's got a 24, 48-hour turnaround time, something that we can do an upfront valuation, or something that we can, it might be a slightly higher interest rate and it might not fit all of your parameters, but it's better than missing out on the property. So we can always look at that. And as I said before, we're looking at a long-term strategy of working with you. So we can always position you with one lender for 6, 12 months and then take you across to another one and work there to try and get you the better deal at the time. So, but once you start asking for extensions, and I'm sure Kaylee can back this up, that once you start asking for extensions, the seller starts to gain an upper hand in negotiations, and particularly not so much right now, but probably 6 to 12 months ago when there were backup buyers sitting there, the sellers could really have a lot of sway in this. And if they've got a backup buyer that said that they're going to pay another $50,000, why wouldn't they take it? So you've got to make sure that you protect yourself really well there. We've got to have a plan B and a C sometimes. But look, yeah, thank you for giving me the chance to talk today, Kaylee. Oops, you're on mute. You're on mute, Kaylee.
There we go. Sorry. Thank you very much, Matt. Really appreciate it. So yeah, obviously there's a lot that goes into getting a formal finance approval across the line that a lot of people don't realise, and there's a lot of stress and things like that. So you definitely do help to take some of that burden off the buyer to make them a bit more at ease and get everything done behind the scenes, which is great. So we'll open it up now. If we've got any questions, feel free to take yourself off mute. Otherwise, you can pop them into the chat bar. I've got a few here. I'm just going to open this one up. Okay, so first one, me and my brother are first home buyers and we are jointly buying a house. will both of us get the tax benefit available to first time buyers is the first question. So essentially, in terms of there is a first home transfer duty concession, and it doesn't matter, you know, if there's two people buying it and they're both first home buyers, they'll both get it. That can even apply even if it is one first home buyer and one is not. It goes on what the share is. So in this case, you know, you're both owning 50-50, but, you know, like I said, it could be you buying a home with your spouse. They've owned a property before, you haven't. On your share of the property, you would still even get that first home transfer duty concession. There is a threshold though for the transfer duty home concession though. So obviously you just need to make sure that you are within that limit of it. There's obviously a first home actual grant as well for first home buyers, but that needs to be a brand new property that's being purchased for that to be available. And again, yeah, you're both eligible to it with the grant. Obviously, it's just one payment though for one property, so you're not both getting, you know, the same grant twice. Now the next part of the question, so at say 6%, what will be the cost of purchase of a property at the end of a 30-year mortgage? I don't know, Matt.
Look, I'd probably get you to send us the scenario because we actually do work out part of our presentation to you to make a decision is give you the overall cost for the life of a 30-year loan. And look, it's one of those scary numbers that you really nobody really wants to see, is the honest truth. But what it does is it does compare lenders and what the total cost would be in that process, including fees. So because some lenders might have a slightly cheaper interest rate, and you might be sitting at say 5.5 versus a 5.8%, but their monthly fees might be $20-30, and over the life of the loan, you might see a real difference in that. So it's part of the product comparison that we actually send out. So I can run those numbers, but yeah, probably a little bit tricky to do on a webinar.
No worries. The next part of the question is the amount paid to an escrow account safe from any manipulation by the seller? Assuming that's in relation to the deposit, and yes, it is. So it is put in, well, you need to make sure that you don't want to be putting it into the seller's account, but it should always be going into a trust account. And as mentioned, that trust account should be at the agent or the seller's solicitor. Now with trust account, you know, they're highly regulated. We can't just release that money at our own will. We need to be authorised by both parties involved, which would be buyer and seller. So yeah, it is very safe being in a trust account. And then the last question there is it likely that a buyer will get a better price than a seller if the purchase is self-funded? So not necessarily. It depends on the situation and what the market's doing. For a seller, though, obviously, if they've got a contract that's not subject to finance, it's likely going to seem more attractive to them, and as they know the deal's not going to potentially fall over. However, you know, if they've got another buyer in the whims that is wanting a finance clause and is paying them quite a bit more, they may be willing to take that risk, knowing that they're going to get a bit more from the sale. So, you know, it really depends on what the seller's appetite is in regards to that, but not necessarily the case all the time.
I think it's also important to find out what the seller's circumstances are, because something like that, like even a longer settlement and a cash purchase, and they're trying to buy something else, it gives them guarantee, like it gives them comforts that they can go and shop. So yeah, look, find out about the seller's circumstances, because look, it can be quite a good bargaining chip. And yeah, but look, definitely find out how you can use it.
Yeah, wonderful. We don't seem to have any other questions there. If you do have any, though, you can obviously contact either myself or Matt after this webinar. What we'll do as well is we will send out a link to the recording and also a copy of the actual PowerPoint slides to everyone that's registered for this event, so you can listen back to it and you know, have a look through the slides if there's something you're unsure of. But like I said, feel free to reach out to us, and we're happy to answer any of those questions. In particular, that's John that's put that question there that had, you know, wanting to know, you know, exact costs. Matt can kind of go through that with you a bit more. But yeah, thank you everyone for your time and appreciate your time as well, Matt, in joining us.
No
And
problems.
hopefully that's
Thank you.
given everyone a little bit more insight into, you know, how the mortgage process works and, you know, the risks and things when it comes to, you know, making sure we're settling on time and paying deposits and things like that by the due date. So enjoy the rest of your day, everyone, and thank you very much.